Here's a key reason why we have a very big economic mess today. Hello, I'm Steve Forbes, and this is What's Ahead, where you get the insights you need to better navigate these turbulent times. When future generations look back at the past 20 years, they'll be astonished that so many smart people all around the world in economics, finance, and politics could have been seduced by one of the most destructive economic ideas of all times. The idea that deliberately suppressing interest rates year after year would generate good economic growth. Instead, this dominant dogma has spawned a very destructive global economic crisis whose aftershocks will be felt for years to come. The immediate trigger for our current woes was the Federal Reserve deciding in the aftermath of the financial crisis of 2007-2009 to do something it had never done before, and that was to suppress not only short-term interest rates, but long ones as well. Traditionally, the Fed primarily bought Treasury bills, that is, government debt maturing in a few months. But now it vacuumed up government bonds and packages of mortgages like a crazed addict. Other central banks followed suit. The result was a global suppression of interest rates. Never before in recorded history had the cost of borrowing reached such absurdly low levels, and stayed that way for year after year. No surprise, governments around the world went on a borrowing binge. Politicians, of course, loved it. Debts went up, but the interest cost did not. Free money, it seemed. Financial institutions, desperate for yield, eagerly bought bonds of developing countries. The debt of developed countries also rocketed to levels never seen in peacetime. Larger companies participated in the party too. Why not when the money was virtually free, especially as in the U.S., the interest was tax deductible? But much of this cash wasn't invested in expanding their businesses. It went for buying their own stock and paying out higher dividends. This financial engineering helped boost stock prices. Mergers and acquisitions also soared. Traditional investments to grow businesses grew slowly or not at all. Worldwide, the amount of dollar-denominated debt now stands at $13 trillion. With interest rates rising now as a result of inflation, we're in for a severe hangover. Activities that might have seemed rational when ultra-low interest rates look permanent have all become lethal albatrosses. Numerous companies that were losing money but could get cash will go bust or have to undergo painful reorganizations. Many countries will either default or more likely restructure their debts, meaning lenders are going to have to absorb big losses. So instead of stimulating economic growth, the policy of low interest rates suppressed it. Yet economic officials, especially at central banks, refuse to face up to their low interest rate folly. With so much painful adjustment coming, it is critical for the U.S. and others to renounce this interest rate manipulation. As important, countries must productively stimulate economic growth through tax cuts, deregulation, and stable currencies. Dealing with misdirected capital is easier when times are good. I'm Steve Forbes. Thanks for listening. Do send in your comments and suggestions. I look forward to being with you soon again.